partner, before we go to our next startup, with Chris Hill, partner at Deloitte, to give you an overview, especially for our fintech companies as well, what the current environment looks like and how to make the best of our current financial situation and environment to grow and scale up your businesses. So Chris Hill, please join me here on stage.
Good evening, everyone. Lovely to see you all. You may not remember me, or recognise me rather, from the picture that Suzanne put up on screen earlier on, because I think I was about 12 years old when it was taken. So I'm going to talk a little bit, as Suzanne said, about the broader economic landscape, and then specifically what that means for fintechs trying to get investment and for the investors who are assessing them. I'll warn you now, this starts pretty bleakly, but there is an uptick at the end, so do stick around for that. So firstly, the economic environment. In recent months, it's been just about impossible to escape the flurry of news on the macroeconomic climate in the UK and to a lesser extent in one of our most important trading partners, namely the US and the EU as a whole. We see one day cautious optimism over signals that rampant inflation may have peaked, and then the next day, market reaction to yet another underestimation of the pace at which inflation continues to march. And the effect of the cost of living crisis is very plain to see. The response of central banks has been, of course, to increase base interest rates in an attempt to change behaviours, partly in the hope that reduced spending lowers demand and therefore that prices fall due to abundant supply. However, this aggressive Treasury policy aimed at stifling inflation will also likely have the effect of stifling growth. Our hope is that the dreaded R word is confined locally rather than infecting multiple economies. But in recent months, both the Bank of England and the International Monetary Fund have each signalled a potential recession of the UK economy to be on the horizon. Investment pots will also likely feel the squeeze from higher personal taxes, coupled with the increasing cost of living thanks to that sticky inflation, and an increase in borrowing costs, leaving ultimately less free cash to spend. Now, that has a couple of immediate effects on the investment landscape to do with asset classes. The first is the increasing attractiveness of other types of investments, resulting in a more careful approach to equity investment and diverging portfolios to hedge against risk. In other words, if interest rates are higher and provide a more certain rate of return, equity investment is no longer the default option and needs to compete with other types of assets. With fears of a recession, a general downward trend in tech valuations, and better returns on debt instruments, investors are perhaps less likely than previously to be persuaded to tie up cash in the form of an equity investment, and may be more likely instead to lend cash as a debt commitment that carries a greater contractual certainty of a sensible return. The second is that the restructuring of portfolios and the investment philosophy of funds on a more diverse plane to hedge against risk is likely to lead to smaller pots being available from each individual investor, and quite possibly on stricter terms as a further mitigant against risk. So what does that mean for early stage fintechs trying to secure investment? Well, principally it means that fintechs, as with any other business operating in this economic environment, are likely to find attracting investment to be more difficult than in recent years. That's obvious. It means that the philosophy of rushing out to build a customer base and trusting that a solid profit-making business model will follow at some point are now long gone, and that investors are likely to want to see a shorter and credible path, not just to revenue, but to profit as well. It means that we're likely to see investors conducting enhanced risk analysis with deeper and more thorough due diligence processes being performed before a commitment to investment is secured, even at the earlier stages. And of course, it means, as we've seen with down rounds up and down the chain, that achieving a substantial valuation will be harder, and that in the right circumstances, debt instruments may be a more attractive option. Now, there's a fairly strong argument that to a certain extent, all of this is a good and healthy thing to happen in an economy, and that these recent developments actually constitute a market correction to the inflated valuations that we've seen in recent years. But the extent to which these developments are a healthy market correction, as opposed to a knee-jerk and frankly slightly panic-fueled retrenchment, and how long that retrenchment is set to last, is a matter of some debate. How then should fintechs react in these conditions? And just as importantly, how should investors react? Firstly, for a fintech to secure investment, it will need to have strong fundamentals, a strong bench of experienced people, a solution solving a real-world market problem, a solid MVP which has attractive functionality and good user experience, and a well-thought-out route to market. Secondly, having an AI component to its service may help a fintech to stand out from the crowd, as this one subvertical is experiencing something of a hype wave at the moment. But that comes with a warning, as it may come ultimately with additional compliance risks as legislators around the world scramble to add regulatory hurdles, and the EU's A Act being an example of that. Thirdly, good corporate governance and staying on top of the administrative burden of running a small company would also be prudent, so as to persuade more cautious investors that the fintech has its house in order. That means having all of its contracts and employment documents to hand to aid with due diligence exercises, knowing what its IP rights are, and having any necessary regulatory approvals to carry out its business in key target markets, or at least a clear path to obtaining those approvals. Most of all, though, having a clear path to revenue and profit becomes ever more important, particularly for business models whose growth naturally involves some kind of material cash burn. And what about investors? Investment is, I think, at its core, a mood-driven business. It feeds off and is affected by external factors that can alter what is ultimately the confidence or lack of it in taking a risk, in making a bet on an idea, a group of people, and a promise of success. The investment opportunities are still there. Angel investors, often referred to as patient capital, are in a unique position at this point in the economic cycle. And this is because they are able to find and participate in the best ideas in the market. And unlike funds that have to return capital after a given period, angel investors are able to lay the groundwork for future growth that will outlast the current mood swing. It would be a mistake, in my opinion, to deal in absolutes and to conclude that now is not the time to invest in anything at all. The conditions that make a company stand out from the crowd and make it a good bet in an upswing are largely the same as they are in a downswing. In other words, if the house is in order and is well built, the weather conditions outside simply matter less. And the longer you can afford to stay inside that house, the more likely you are to sit out the storm and emerge into the sunshine at some point. So I hope you consider this evening's event as something akin to a curated version of Rightmove, where you get to see some of the best early stage establishments in the market today, down selected by FinTech Circle from, I think, around 100 applications for you as investors to peruse and consider, even if it's the case that you're more tempted to ask a few more questions about the utility bills and the neighbours than you might have done a couple of years ago. I wish you all happy hunting, and at that point, I will be quiet and hand over to SweetPay.
Fantastic keynote, Chris. Thank you very much. Very, very valuable advice, I think, to both startups and investors. And I also wanted to say that Deloitte Legal is a partner of FinTech Circle since almost 4 years, and very, very supportive of the whole fintech ecosystem. And as you know, we often see London as the global fintech capital of the world. And definitely we can see that Deloitte Legal and Chris and his team have been supportive to entrepreneurs, to investors, since the beginning, and also are the sponsor of today. So the nice, all the nice drinks, everything. Thank you very much, Chris, for being our sponsor and our partner for tonight as well. So with that said, so now we start our next startup, and I would like to invite Bilal to join me, and we're moving on to Sweep. So Bilal, the floor is yours.
Thank you. Hi, everyone. My name is Bilal. I'm the founder of Sweep. We are a fintech company based in the UK, and we specialize in payment automation. Our mission is simple. It's simply to help SMEs pay better. In other words, to bring B2B payments into the 21st century and bring them at match with what the B2C users are already used to. Why does that matter? Because an SME that doesn't pay well is an SME that can't invest in growth like their competitor. It's an SME that can't keep cash flow positive, and ultimately it's an SME that doesn't have a competitive advantage. Payments are complex, although it's a simple transaction. There are many problems that SMEs are facing. The first and biggest one is time wastage. CEOs or CFOs are going to spend entire days per week processing and controlling transactions. So that is paying invoices, paying salaries to employees one by one. 60% of the time used by finance teams is spent just doing that. The other one is cross-border payments. So sending money abroad currently is expensive. You have high fees, and you have absolutely no visibility on where your payment's at until it's received. When you're using logistic chains to acquire equipment and the payment is needed for the equipment to be sent, that causes a lot of issues. On-demand payroll, employees need more and more flexibility in the way they're being paid. There is no solution out there that is really helping with that. Flexible payment options, as I mentioned earlier, as well as quick and short-term credit, access to credit. So what have we done? Well, we've focused on the first problem, the time wastage, and we've built, using open banking, a payment automation platform that helps them pay up to 1,750 payments at once. We also automated everything that is around that payment, so it's approving the payment run, reconciling the payment into the accounting platform, and sending the remittance out to their suppliers. Why are we better than the competition? Payment automation is not new. There is technology out there that offers you the solution, but previous technology will either ask you to move your money somewhere else first, so fund an e-money account or a virtual account. They will ask you to make your money transferred through a middle bank account, so that's the example of TransferWise, for example. Or they will ask you to use employee payment cards like the Plio and the Soldo, and we all know that those cards can get locked very quickly, and each card comes with an individual e-money account that you have to fund. With open banking, we can build and bring all of the benefits of previous technology and build it right on top of the bank account that the SME is using. So we are seamless, we're transparent, and cost-effective. We have scaled our product to 70 clients. We launched last year in May. We are currently processing £500,000 in payments per month. And we have a pipeline of about 130 accounting firms that are ready to buy the product. Some of those accounting firms are extremely large. We're talking about 100 to 150,000 entities under them, not just in the UK, but also in the EU. We could reach £1 million in annual revenue just by selling to one of these, as an example. We have two offerings and two ICPs. So we sell to accountants that are looking to develop a new offering for their clients. They want to provide payment management services using a secure platform, and that's priced at £15 per month. They add a premium to that and generate new revenue. And then pricing to SMEs at £35 per month. We plan to double those price points in the next 12 months. For context, we have competitors such as Teleroo that charge up to £120 and cap their payments at £250 per month. So there's room to grow there. Competition-wise, we are in what we call full life cycle and affordable. A very similar offering is called Comma. They were backed by Octopus and got recently acquired by Weaver. I think it was in March. That leaves us with the only ones with that product on the market. For context, we just turned down an acquisition for £5 million, and we essentially are at pre-revenue. We have a little bit of drill down into what makes us different. As I mentioned, there are payment cards companies, there are e-money accounts companies, and this is where the concentration is and the competition really is. This is where most of the incumbents will be. But then when you look at bank to bank, there are only a few companies, and this is a huge opportunity space that we are tapping into. I'll move on from this one for now. The team is small but mighty. We've been working together for about 6 years. Mark, our CTO, has 12 years of experience. His last two companies were acquired. The goal with this raise is to grow the company in the UK, adding engineers and a sales team. We have one advisor, Vinita Bajaj, who's the group CFO of Ocado. She's here to do two things: help us upscale the product and start selling to more medium-sized companies, talking about maybe 100 and 150 employees, as well as make introductions to all of the logistics partners that Ocado works with. And two core investors, Thibaut Poutrel, whose father was the founding team of Ingenico, now WorldPay, so the leading payment processing company in the world, as well as Johan Belmer, who works at Apollo and is in the room right now with me. What's our strategy? Well, I mentioned we have accountants and SMEs as two core ICPs. Our goal is to have accounting firms as our main customer. They are a huge scaling opportunity. Selling to one accountant can yield hundreds of clients. Then comes the SMEs and the startups. We are looking at both the UK and the EU, open banking being an EU-wide framework that gives us the opportunity to grow there as well. Three pillars commercially. We are looking at B2B partnerships. That means integrating our solution to adjacent services. We're talking about accounting platforms, accounts payable platforms, expense management platforms that want to have payments as a feature but don't want to build it themselves. Then cross-selling new users into our existing products, as well as using traditional outreach, as I mentioned, looking at accountants and SMEs as our core target. We are currently raising 1.2 to 1.6 with 750K already committed at a £6 million valuation. The challenge for us is commercial scaling. So this is where most of the budget will go. The product is essentially at product market fit. So it's about launching that in the UK, launching that in key EU markets, and scaling commercially as quickly as possible. That's it. Happy to answer any questions you may have.
Please. So thank you very much, Bilal. So let's open up for questions. Here, first one, Bakas. If you can give one microphone.
Thanks, Bilal. It's a great presentation. Just could you elaborate a little bit more on the preparedness or the readiness of the product to be able to scale? You said you have 70, I think I implied sort of smaller customers. You want to get to the 150 plus. What do you have to do to the product and the platform in order to be able to get there?
Yeah, so our focus over the last few months has been to bring the product to product market fit. There are many challenges with open banking. It's still an evolving framework. So to build bulk payment on top of UK banks takes a lot of work. A lot of the issues and bugs that you find out about in the initial stages take months to fix, simply because the banks don't reply to you quickly. And it doesn't matter if you're a new startup or a big company, they just don't care. So we've gone through that process. We've sold to accounting firms as well as SMEs, so we understand what features they need, and we've built these features. There maybe is a couple more smaller features that will take between 2 to 3 sprints, so we're talking about a month or 2 of work, to make this product a kind of fully ready product. And we have a lot of accounting firms that are waiting for these features to start using the product. So we're very much at this stage now, ready to scale very quickly and very efficiently.
Perfect, Bilal. Yes. Yes, please.
So you said you're in the business of moving money for different use cases. Do you see any need for regulatory compliance, and how are you going to tackle that?
We don't need to be FCA regulated. We use a company called Yapily to plug into banks, so their license extends to us. We will be looking into and getting an EMI license if we end up having virtual accounts in the name of the clients. But that's not something that's been confirmed for now. So for now, no regulatory need.
Perfect. One more question. Who's got another question for Bilal? Yes, please.
Thank you so much for the presentation. What's the real barrier of entry here? I mean, you explained that it's difficult for banks perhaps to cooperate with you, but I guess if I start this, if I'm cynical, I'm a cynical Viennese like Suzanne. If I'm cynical here and I come with a lot of money and start the same business, I'll obviously take me out. What's your advantage said there are a few others who are taking out, but a lot of people could start the same business if it's profitable business, looks like very profitable.
Yeah. So there's a couple of things here. Open banking is still evolving. So only the UK has launched bulk payments for now. France and Germany are looking at it, but haven't done it yet. So there's a first mover advantage that we can repeat in every market that we penetrate. Second of all, there's the technology. It's not simple to build. So you can come up with as much money as you want. You will still have to wait months for Lloyds to get back to you and tell you why this bulk payment is not working. Same for Barclays, same for HSBC. And then expect the same in Europe, maybe even longer there. So there's that. And then there's the relationships with the accountants. I think there's a big opportunity around educating the market on what the possibilities are of open banking. We're doing that work. We've understood how to sell to them. We know what they expect. So again, it's about keeping that competitive edge and capitalizing on it as quickly as possible.
Perfect, Bilal. Well done. Thank you very much. So now we're moving to our next capital markets fintech, and I invite Liquidity to join me on stage. And I hand over to Nicolas.
Good evening. We are Liquidity, and we are developing a fully regulated capital market for illiquid assets on blockchain. One of the issues that we had in terms of the banking markets is the banks never used to really care what they did with their private loan assets. They moved them on. Credit funds were very willing counterparties to take them on. They moved off the bank balance sheets. It wasn't really so much of an issue for them. They're happy to move them. But the situation has changed. Not only is the economic landscape changing, but with impairment of loans and questions over growth, but also credit funds have grown large. They've taken the opportunity and grown very big. So one of the problems they have in this market is that banks still need to hold capital. They need to take this a lot more seriously, and they need to sell their existing private loan assets. But the problem they have is that the buyer market, the buyer power is actually very strong. And of course, they're negotiating discounts. Credit funds negotiate strong discounts. And so banks are becoming price takers, having to discount their loans in order to move them on. And they've tried moving them down to their clients, but the trouble they have with their clients is they just kick illiquidity down again. And of course, bank loans are probably one of the largest liquid asset classes in the market. And it's no wonder then you can see with those kind of discounts that the amount of capital flowing into private debt has grown enormously, about 1.4 trillion to this point, and it's actually grown much larger for those of you aware of it. And so what is liquidity? Well, you can think of liquidity really as a utility. We're trying to sit in the middle. You can think of us like a SWIFT network or a Visa, working with banks to allow them to be in control. So a corporation can come to a bank and ask for some new loans. Our existing bank loans can be sold. And those two agencies inside of a bank come and talk to liquidity loan management, who are really the back office of what we're developing. Managing loans as an independent agent, but really creating the tokens and the tokenization that goes on the platform. That goes on to liquidity capital markets, which really is the front office for our business, and the thing that most people actually see, where we can actually trade loans in amounts across the platform. And if we are a utility, there are really three areas that we need to nail. We need to be trusted. We need to be trusted by banks, and that requires regulation. And so working with the FCA to be a properly UK-registered capital market in our first instance, with independent due diligence and independent credit rating that's updated quarterly. We need the technology to work to connect people, and because this is about liquidity, there's no point trying to sell people in $500 million chunks each time. We can actually take our tokens down to as little as $1,000 or less. That allows people to generate new products in the market. And these have to be tradable. And we have our first London market through a partnership, which allows new capital sources and trading in these products themselves to actually to drive liquidity. I'm not going to spend long on this slide. This gives you a quick summary of our ITO process. But the point to really take away from this is that we leave banks in control. Banks decide what it is they want to sell, how much they want to sell. They don't have to tokenize an entire loan. They can get market data for a mark-to-market basis. We can take impaired loans, we can take performing loans and put those into the marketplace. And then we can have those products tradable from small amounts.
using auction technologies and bringing in capital that wants to go into this market. One of the key things in this market right now is the banks need to sell, and there's a wall of capital that wants to buy, but at the moment that capital cannot access this market. We're really breaking this open for the bank's benefits. So we've talked to this. Is this just a simple bit of hubris? No, we've actually talked to the banks, to the banks that you will all think about, and a lot of other industry participants. And so what they're attracted to is a fully regulated marketplace, because that allows them to sell and structure new products. New products to sell to wealth management clients to bring in fresh capital is enormously attractive. The bank treasury teams are all keen on moving on loans for the reasons that we've heard about earlier. And also looking at digitization and tokenization, banks all know they're coming. Large banks are spending a huge amount of capital into this market to be able to bring in their issues, and I'll talk more about that in a moment. But smaller banks can't. There are over 6,000 banks in Europe, they cannot spend that kind of money. So we are a de facto solution for those banks themselves. We allow those banks, because of the way that liquidity works, if they wanted to write a new loan, they don't have to commit, let's say, $100 million to write it. They could commit maybe 10 million, 20 million, and source the rest of it from across the capital market itself. And so for our team involved, we have Claire Cummings, who some of you may know, for regulation. We have Naz Kaderi, who's here as well for capital markets. We have Marion Morgan, who's experienced fixed income developer. We have Dougal Breck, who's with us this evening for relationships, and we have myself in terms of bringing together international businesses. So a good strong team. We have more people joining. And so for 3 areas, when we're actually talking to you now about, is about the proof of concept itself. So it's launched under Liechtenstein law for the proof of concept under regulatory umbrella. And why is that important? For those of you who don't know, that Liechtenstein is the only jurisdiction in Europe that actually offers proper regulatory coverage for digital assets. And we feed that in with the FCA for the full launch under the FCA. And that's important as well, because that's really giving us a 2-year head start on anybody else. The tokens become tradable on entering a UK exchange, and we're fortunate enough to have Adrian Ip from Aquis Exchange join us this evening as well. That allows, even for our proof of concept, the existing range of wealth funds and broker dealers to be able to access these products in an early stage. And we can feed back this because, as we know, regulation is a market that is a marketplace that's changing, and there are a lot of issues globally. So we are teaching the FCA in this process. For our actual proof of concept itself, we have three issuances, 1 new raise, and it acts as a test. The reason for the proof of concept is testing this market, both for industry participants and for our partners to understand how things fit together and how we can improve for a full launch. And then for our partners, as we say, so we have Bank Frick in Liechtenstein as a regulatory umbrella for token issuance, Aquis for providing us with our capital markets, Moody's for credit rating, which are updated each quarter, and also some partnerships with some banks for processing and transfers. And so very quickly, just to wrap this up, what are we raising? We're raising roughly around $1 million in a UK compliant safe product, and hopefully you know what that is, but if not, we can talk about that. For 10% common equity, which equates to about $10 a share now, we're SEIS and EIS advance assured, and the whole proof of concept process to go into the Series A launch is around about a year. The Series A is around a 15 million raise, which we always have a lot of interest in already, a full launch under the FCA himself, and then with our full dedicated capital market, the exit route for any investors is roughly around 5 years beyond that launch, and you can see that once our other regional exchanges, which we can talk about later on, come onto market, roughly in terms of where we raise our revenues, so the ITO issuance, which is actually issuing the new tokens, from the trading part of it, which we're very conservative about, of actually those tokens themselves, and then for managing loans as an independent agent. But as a very high-level overview, because there's an awful lot of detail, that's liquidity.
Wonderful, Nicholas, thank you. So please take a seat, and we open up for questions, and the team of Liquidity joins us on stage. So who wants to ask the first question for Liquidity? Yes, please, Mario.
Thanks. Thanks for the presentation, and congratulations on launching. Why Liechtenstein? What is beneficial about licensing there?
Sure. So Liechtenstein is the only jurisdiction inside of Europe that gives you specific coverage under law for tokenized assets, digital tokenized assets.
Passportable to the UK? How do you?
Well, the coin will be issued, first of all, in Liechtenstein, but traded in the UK. Bit by bit, the way that that will work is that once we have FCA approval, then the tokenization will always happen in Liechtenstein until somebody else has the same legal framework. So really what we're doing, Liechtenstein have decided to set them up as a digital industry expert. So they specifically aim their laws at making sure you get the best protection you possibly can. So that's what we're getting from them. We expect over a period of time for everybody else to catch up. So the FCA are really interested in this. So we're in their innovations lab and their sandbox. And what they're doing is they're watching to create their own regulation around this. But you know, you look at the UK, we're fairly progressive. You look at the US and they kind of started out as a market leader. They've come way, way back. The SEC is now punishing this industry in one form or another. I think what's really interesting about this for us is that we're taking, if you like, the digital world, which everybody understands as being the Wild West, and taking what it's really good at doing and putting it into the traditional model. So therefore everything is regulated, everything's done through. You have a proper custodian, you have a proper exchange that's regulated. So really what you're doing is you're making the most of the efficiencies of new technology, but making sure that investors and everybody have all the protection. Why do banks want this? They want it because they're sitting on a lot of liquid assets. You know, one of the issues is they sell something and then they don't worry about it until it comes back onto their balance sheet, boomerang style. And at the moment, we're going through 2008 all over again in one form or another. Banks' balance sheets are under significant pressure. So you've got that driving forward, if you like, the need to digitalise because it's the only way really of making these assets liquid. And I think as Nick mentioned then from the top level there, you've got the private banks that are turning around and saying all their ultra high net worth clients are jealous of hedge funds, right? Because the hedge funds have the expertise, they're already making the money. They're turning around and saying, how do we get access? And actually that's something that's now called in the industry, the retailization of private credit. It's not really about people on the street buying it. I think that comes in another 10 or 15 years. But this is allowing another level of investors to come in. So really what we're providing here is a solution for both sides. Number one, banks need to get rid of their assets. Number two, ultra high net worths want to have interest in this. Let's package it all together. Let's put regulation around it and make it work from there on in. But the reason for Liechtenstein, to come back to your question, is really simply because they have the right amount of investor protection and they've specifically written their rules to protect investors in that space.
Thank you.
Yes, please, second question.
So what is the liquidity of these tokenized loan books that you're putting into 1,000 euros? Say somebody puts in 100,000 euros, what liquidity do they actually have?
Naz can probably answer that.
Yeah, I think in terms of. Oh, sorry. Yeah, I mean, in terms of what we're looking to do is we're looking to create a whole ecosystem around these loans, as Dougal was saying. And so all the way from issuing these loans, subordinating these loans, to then transacting on a secondary market via these loans is sort of the whole sort of concept behind liquidity. And that liquidity that we're going to bring to market via Aquis as an exchange initially in the UK is really going to come from the likes of market makers. It's going to come from the likes of the investment banks. It's going to come from wealth managers who want access to those products. So all of those firms will automatically get access to that liquidity via the same platform they trade, stocks like Vodafone and other sort of blue chip names here in the UK.
So I think the answer is it takes time, number one. And number two is you think about ETFs. ETFs in the 1990s were brand new. Nobody looked at them, particularly this is exchange-traded funds, by the way, for people that don't know. Nowadays, they're one of the most traded assets out there, full stop. They're used for hedging, for sector-specific. So this is just a new way of giving liquidity to something that has really been illiquid for a long time.
I'm an investor in tokenized illiquid assets.
Okay.
But I don't expect my money back for 5 years.
So what we're aiming to do by providing this market, and I think what you have is you have the market makers or the prop funds that come in straight away. They're, if you like, your first market. What they're going to be looking for is arbitrage between what is tokenized and what isn't. So that becomes the perfect, that's how you kind of encourage people in to the market. So that's where it begins. But then I think as Naz said, then you get the ultra high net worths coming in. Some of the hedge funds will be paying the arbitrage. So bit by bit, it will take time. But I think to your point, I don't think the liquidity comes in a year. I don't think it comes in 2 years. I think bit So recently Goldman Sachs did a digital asset. It sold well, by the way, of course it would do. But the one thing they didn't do is it wasn't tradable on exchange. So it may as well have been illiquid from day one. SocGen have also tried the same thing in one form or another. When we went to go and talk to banks, what we found from them is they know they need an independent to run this. Because if Goldman Sachs runs this digitalization, nobody's going to trust it. Nobody else in the industry is going to use it. You know, SocGen tries to do it there at the other end, and they don't have as much expertise in order to be able to do that. So having somebody that can sit in the middle and effectively create, I think as Nick said, a swift network that everybody buys into, it becomes a conduit then for liquidity for the whole of the market. So I think what we're giving you here is an opportunity to buy into something that is definitely going to be there. It's just early stage, and I think to your point, you're really in it, so you understand it will take a couple of years to get proper traction.
Perfect. Very done, all three of you. Thank you very much. So now we're moving to our 7th startup, and I would like to invite Surety Randeep on stage. Let me go to your starting slide, Randeep. Here we are, Surety Green. Over to you.
Good evening, everybody. My name's Randeep. A little bit tired, actually, but bear with me. So I'm here today to talk about Surety Green. Surety is essentially a RegTech platform, and our vision is to become a global leader in digital compliance software with a focus on sustainability. Okay. So essentially, we're trying to address a number of different challenges that are faced across the industry at the moment. So one is the volume of sustainability requirements is on the rise. Month on month, this is increasing irrespective of which sector you're in or which jurisdiction you operate in. The other thing that we're observing is that regulators and governments are applying a lot more scrutiny when it comes to compliance and adherence, and they're starting to show their teeth. So what this really means by way of implication is that, you know, best case scenario, if you get it wrong, actually you'll get a rap on the knuckles, regulatory censure, which can work its way up to fines, which worst case scenario can actually result in loss of license. And of course, the other issue is not just the risk of non-compliance, but also the cost associated with trying to be compliant. So we know that the operational cost of being compliant for most banks is around 10% of their general operational budget. And so getting this wrong increases risk and actually creates barriers to growth in different markets. Getting it right, however, can equate to a competitive edge. So our focus for today is we have a number of target markets that we're addressing, but we're focusing primarily on the UK and the UAE. Our customers are startups, SMEs, NGOs, and enterprise organizations. We're focusing on 2 verticals, sustainability primarily, but also financial services across that. We're looking to raise 500K for 15% equity, pre-money 3.5 million. So if you look at the regulatory landscape, it's vast, and it's, as I mentioned before, it's increasing multifold. If you're a chief compliance officer for an organization, this becomes a minefield for you, just to work out which regulation you need to adhere to, but also how to actually work your way through more than one if you're operating in multiple jurisdictions. So this is where we look at how important this is from an industry perspective. There's a number of issues out there. So if you're an organization that's claiming to be sustainable, you know, you're facing a lot of scrutiny, not just from regulators, but also from your consumers. They want to make sure that what they're buying into is actually green these days. And likewise, it's not just consumers, but employees as well. So people that work for your company want to make sure that they're working for an organization that actually is doing the things that it says it should be doing. In addition to that, there's also a lot of activist investor scrutiny as well. So investors are looking at the companies that they're investing in. They want to know that they're not greenwashing, that what they're actually investing in is going to be green and has a green operating model. It's not just being sort of greenwashed for marketing purposes. Now, that's obviously the stick, but the carrot is improved profitability. If you actually apply the controls that you need to be more sustainable, you'll find yourself with a more streamlined operating model and certainly a more streamlined supply chain. So this is where Surety Green comes in. Surety Green is an AI-driven RegTech platform. Essentially, it takes regulatory artifacts, digitizes them, decomposes them into their parts, allows you to then map that through to your operating model by way of controls, and then basically puts you on the journey to measure yourself and report on the same in a very transparent way. And it can do this across a multitude of regulations and irrespective of sector and jurisdiction. So we've built the platform. It's very early days for us. We did a soft launch of it at the beginning of last year. We've trialed it with participants from multiple sectors and also 2 different markets, the UK and the Kingdom of Saudi Arabia. And we want to evolve it from here. Now, the marketplace we're going to be participating in is vast and it has huge growth potential. It's valued at over 1 billion at the moment with a CAGR growth rate of 15.3%. And when we look at the competition, yes, there is competition out there. However, we are going to compete on content, config, and comprehensiveness. So what I really mean by that is the content is something that we're going to sell. Every time we actually deconstruct, decompose, and map through a regulation, it becomes an off-the-shelf product that we can offer to multiple clients in a segment. So effectively a snowball effect. In addition to that, we're very big on client configurability. So we have an extensible data model, which means that the end client can actually take the platform as an empty shell, fill it in themselves with content, or we can provide that to them. But every step of the journey, they get to model it the way that aligns to their operating model. And then finally, comprehensiveness is really about ensuring that we map the end-to-end life cycle. A lot of the competition focus on one part of the journey. So they'll focus on the data challenge as opposed to the interpretation challenge, the workflow that's needed to actually measure this stuff through, and then, of course, the reporting piece on the end. So, as I mentioned earlier, we're focused on 2 verticals, financial services and sustainability as a big bucket. Right now, we're zeroed in on the UK and the UAE, but we plan to expand beyond the Middle East simply because the barriers to entry are much lower there. And then, of course, as we've developed the platform, we want to expand into the more mature markets. Partnerships are really key to us. So right now, we're sponsored by Microsoft to the tune of around £150,000. So we built the technology on the Azure cloud stack. Even though we are cloud agnostic, it can be deployed to any cloud environment as well as on-prem. And again, just coming back to the point on content, we've just signed an MOU with the GRI, who are a preeminent global sustainability disclosure framework provider. And they've allowed us to use their content within our tool and sell that on. In addition to that, we're obviously working with various procurement networks, cloud B2B marketplaces, and professional bodies and academia as well. But the big partnership that we've just landed is a revenue share agreement with HCL Technologies. So HCL have basically signed us up. They're white labeling our product. They're aligning it to their product, which is called Dry Ice. Dry Ice is basically a £250 million a year business. What it does is automated control monitoring against business processes. What they want is regulatory context, which is what Surety provides. So we're now plugged into them, and they're actually helping us to onboard our first paying client. And actually, they're spending a lot of money marketing us too. So recently, from that picture you can see there, we were at the Global RegTech Summit in London on Bishopsgate just a few weeks ago, where they demoed the platform for us. So it's a SaaS-based subscription model tailored to the type of client that you are. As I said, we're looking to serve startups, scale-ups, SMEs, NGOs, and enterprise organizations. And of course, this will vary depending on the requirement. So what do we want to achieve? We want to get to round A within 18 months. So just working back from that, we believe we need to achieve 2 million ARR, which is something that we think we can get to. In terms of what it is we need to do to get there, we're very clear on what we need to achieve. We've already done a lot in our own time, on our own dime. We've got ourselves to this point. We just want to grow beyond. And so at the moment, we're focusing on our first client onboarding. We've also just signed a 5-year agreement with a federal bank in the Middle East, and that's going to be kicking off in a month's time, as approved by their board. And actually, just today, we signed up an organization associated with the Qatari government who also want an exclusivity agreement with us to deploy this platform to the government entities in Qatar and potentially beyond. And so we're looking to move forward from there. Obviously, we want to get through this seed round, build out the tech team, take full advantage of the opportunities that are ahead of us, and then, of course, develop the product roadmap and formally launch in those other markets and get ourselves on the way. So this is the team that's making it happen. I've got over 20 years experience financial services, driving regulatory transformation. John is ex-FCA and has also been a compliance officer for a number of big banks, so very well understands compliance and regulation. Richard is well known in the RegTech circles. Tony's our man on the ground in the Middle East. And of course, we're advised by two amazing women, Ilana Adamson, who is very much plugged into the sustainability ecosystem. So she takes part in government workshops, she attends all the COP sessions, she understands what's coming our way so she can advise us. And of course, Sarah was nominated by Forbes as top 100 women in fintech, so she's advising us on our go-to-market strategy. And so again, we want to raise 500K, spending most of that predominantly on product. Why would you want to invest in us? So we're a proven team, we're of the industry, so this isn't a conceptual thesis, it's something that we've seen, we've touched, we've filled, we've validated in the marketplace. We've also proven the concept with trial users and with people that now want to buy the product. We see ourselves as a stable investment. So if you are looking for a stable, relatively boring part of your investment portfolio where you may have a gap, then actually we can fill that gap. Very much a utility. And again, the clients see us as non-discretionary spend. So this is something that you must do in order to actually meet your regulatory obligations. And this will make it a lot more efficient. Also, we've got tangible opportunities ahead that I just laid out. And of course, just from a growth perspective, this has potential to go beyond the sustainability use case. So this platform can actually be pivoted to any regulatory requirement, irrespective of sector and jurisdiction. Thank you.
Well done, Randeep. Excellent presentation. Thank you. So let's now open up for questions. So who has got the first one for Randeep? Yes, please. The microphone is coming.
You're going to spend £50,000 on sales marketing to drive £2 million of revenue. What are you going to spend at £50,000 on that drives that much revenue?
Yeah, that's a really good question. So actually what we're hoping to, that will just be us as a core team. We're going to be leveraging a lot of the marketing budget from HCL. So HCL has a sales force of over 200 people around the world that we're going to be plugged into. So actually we can go a little bit lighter in terms of our own spend. Yeah.
Yes, second question. Yes, please.
Why have you picked the financial industry? This is a generic product. It could be, in my view, at least, could be applied to all kinds of industries, yeah? And they all have the same challenge. And I've seen similar approaches taking AI and readout of documents to and workflows to improve it across industries, yeah? So why pick the financial industry especially?
Look, you're absolutely right. So what we've done is we've stuck to the industry that we know because we're from that industry. But look, this product can be scaled to any regulated industry, healthcare, pharmaceuticals, oil and energy, the list goes on and on and on. So the growth potential for this is absolutely massive. And what will drive that growth will be content. So every time we actually deliver, say, a regulatory use case to a particular client, that for us becomes genericized, becomes an off-the-shelf product that we offer in our regulatory marketplace and just continues to expand. But just coming back to your point, yes, this has potential to go beyond, way beyond.
Randeep, last question for Randeep. Who's got a question? Yes, please, Chris.
You had a very useful list of competitors. One name on there I kind of recognise. Do you see that any of those will look at what you're doing and try to expand their product set? I'm not going to talk to those guys, don't worry. Do you think they might try and expand to kind of match what you're doing? Is that
absolutely. I mean, look, as I mentioned, there's a bunch of things in the platform that sort of secret sources, you know, if you will, right? So AI-driven capabilities, obviously the extensible data model. As I mentioned earlier, the content is going to be key for us because that's actually what we're going to productize and sell. And ideally, that name that you recognize might even look at this and think, oh, there's a potential partner there. So that would be the strategy.
I can talk to them if you like.
Yeah, please do. Let's have that conversation.
Fantastic, Randeep. Thank you very much. Thank you.
Thank you.
And before we go to our last startup of tonight, I want you all to go back to your feedback forms, please, your investor feedback forms. And now vote on those last 3 startups which we just have seen. So Surety Green was just now by Randeep. Before we had Liquidity presenting to you. And the first one was Sweep Pay, was our first one when we started after the break. And again, provide your comments, please, which companies you want to meet up again, or talk to the CEO, get more information. And you can all complete it. Yes, and in the meantime, I would like to ask the last startup to join me tonight, Eureta CEO Manish. Manish, please join me on stage, and we go to your slides now. So Manish, the stage is yours.
So I'm the lucky person that's holding you all from dinner. Lucky me. Thank you all for coming today. I'm Manish Karani, the founder and CEO of Eureta. A bit about me. I have, for the past 5 years, been managing my own impact investment fund. Previous to this, I was banking at Coutts and Credit Suisse. Eureta, back onto why we're here today. We're in a fight. We're in a fight against climate change, inequality, poverty, and many other things. What is Eureta? Eureta is an impact platform that connects entrepreneurs with the right investors, backed by the world's top advisors at speed. And what's behind us? What's our secret sauce? Bit of a guessing game here. I hope all of you know who many of these individuals are. But did you know Oprah had a miscarriage, tragic miscarriage at the age of 14? Einstein was diagnosed as deaf up until the age of 6. Nui shattered the glass ceiling and became the first woman of color to be CEO of an S&P 500 company, even though she suffered and encountered ridiculous amounts of marginalization and prejudice. All of these individuals at a young age encountered hail, hardship, alienation, illness, and loss. So, our secret sauce, Eureta entrepreneurship. We believe that individuals that encountered hail at a young age resulted in them identifying their purpose. And what we believe results in this is Eureta entrepreneurship. A bit about why I'm here today and why this is important to me. I became type 1 diabetic at the age of 6. I've had 40,000 plus injections for the previous 30 plus years, and I will continue to have these injections for the rest of my life. I lost my father in 2017, and he was an accountant. And actually, during his funeral, I attended his funeral, and I met 100 of his clients that came to his funeral. And actually, by the time I got home, we were starting to consolidate his finances. I was looking through his numbers, and normally numbers is his forte. He was an accountant. I looked through the numbers, and there was no revenue coming through the business for the past 5 years. So I picked up the phone to his 20 clients, 20 out of the 100. And I said, look, can you just explain to me why you've not been paying him or why he's not been charging you? And they all took the time out to speak to me and said, we insisted to pay your father, but he refused to take any money from us. When we were speaking to him, we couldn't pay our children's school fees. We were going to lose our house and we were going to lose our business. And he consistently decided that he wanted to help us. At that moment in time, I identified my purpose. If my father, an accountant, could support 80 people running his own independent business, I have an ability and an opportunity to help tens of thousands of people. So what I did, I quit my banking job in Singapore, in Coutts, came back to London, and I started my mission to prove that entrepreneurs that had encountered hail were the best entrepreneurs in the world. So what I did, I put together an impact fund. I invested £5 million across 15 companies. I didn't tell them I was looking for hail. Across those 15, 8 of them had hail, the others didn't. The results were definitive. It was a clear solution which confirmed the valuation revenue uplift. The numbers worked. I knew that I was presenting this at some point to investors, so I needed something more. I got academic research done. I spoke to University of Oxford, LBS, King's College. I need something which proves that this is not just my theory that I've come up with. There was a positive correlation when they run the academic research between hail and entrepreneurship at a 95% significance level. Secondly, in order for us to meet our mission of backing tens of thousands and moving more money into impact, we had to do this at scale. And that's where we brought data scientists in, machine learning experts in. Impact entrepreneurship is very personal to individuals. It's not like ESG, it's very personal. So we need to be able to measure that and understand people's purpose at a grand scale. So we built a team around what we're creating today. Of course, AI is one part of it. But we have a brilliant team that's going to help execute what we're doing. From right to left, Jonathan, founding partner at Crowdcube, now head of growth. Amar, founder of Dishum, also did statistics at Cambridge University. Kirsty and Anna, neuroscientists, machine learning experts, data scientists. Business, revenue, very similar to what we've been doing for the past 5 years. We would charge a transaction fee when investors invest via our platform. We will have our advisory network where we will take a rev share of whatever they charge the portfolio companies. And we will charge an onboarding fee for the advisors to come and list onto our platform once we get to a certain scale. Use of funds. We're raising £750,000. We have full SEIS and EIS. In all honesty, for me, I want a type of investor that knows how to build and scale these types of businesses, but an investor that leads with the heart and executes with the mind first and foremost. Eureta, an impact platform supporting the next generation of entrepreneurs with the right investors, with the world's best advisors. Thank you.
Well done, Manish. Fantastic. Please take a seat. Yes, please. Okay, let's start with the first question for Manish. Who wants to go first? Maybe everybody's speechless after your presentation. Yes, please.
Thanks, that was great. It was really inspiring. How do you get the advisors on board, the world's best advisors?
So I think we're relatively fortunate that because we obviously have a track record of doing this, we've got a combined list of about 35, 40 advisors already that work with us through our existing portfolio. So these are the founders of the Dishum. These are the ex-CEOs of Slug and Lettuce Pub Group. So we have that that's there. For me, the way that we win this is to build a consumer-facing brand that people appeal to. Entrepreneurs, advisors will appeal to the story that we create through our brand. If you look at our branding, it doesn't look like a finance brand. It's a brand that appeals. And with all due respect, the best investors, advisors that I've met are the ones that care a lot about moving more money into impact. And they will come once we build up the brand. Secondly, advisors, there's one of our clients, people have this kind of connotation that people with money are just not good people, but that's not the case. I think people that have money, well, mostly, people that have money want to help others, and they will introduce other advisors to the network, especially when it's for a good cause. So again, not massively worried about that from that regard.
Another question for Manish. Yes, please.
Hi, just a specific question on the cut-off date for the investment track record. You put up 33% IRR in the last 5 years. What's the cut-off date for that, and are they all completed actual exits, or is there some paper valuations in there?
Yeah, so it's a blend of realized exits. So we've had 3 exits already, and then the rest are, you know, maintained IRR just on obviously a book value.
And do you know the date? Do you remember the date roughly? Is it like last year sometime or this year, or?
When we had it valued?
Yes.
Oh, it was Q4. It was Q4 of last year. Yeah.
Brilliant. Final question for Manish and the orator. Maybe what I will do then, can I ask Amar, who is here with Manish today, just because Mana, you are a support advisor to Manish, to your orator, and of course also the founder of Dishum, I believe. Is this right? Yes. So would you mind to explain a few words why you believe in orator and why you're supporting Manish as CEO?
So I think Manish and I actually met last year through one of his portfolio companies. He was speaking to me about it, coming on board as an advisor. We got talking about this, and as these things happen, just as much as Manish has a personal story around Hale, I have a personal story of my own, which I won't share right now, but it's something that has driven me for the last 20 years, and that's where the connection came. And if I look back at Dishum and a number of the other brands that I've worked on, there's a thread that we could see through that. And so that's what triggered it. And so I strongly believe in this, which is why I've been pushing with this.
Fantastic, fantastic, Amar. So thank you very much, Manish. And of course, now we've got much more time to network and to get to know each other and talk about each of our startups which presented today. So first of all, I want you to invite you again, go back to your investor feedback forms, you know, which you started, and complete the last form now for Manish, for your orator, and tick, you know, the right box, how you want to follow on with the team. And then at the end, just please press submit, and then we will get all the information as soon as you've done it. And you will also get a copy. So we've set it up in a way that you get a copy as well, how you voted, so that you can remind yourself what we will do then. Those companies you want to get introduced to, you know, we do the introductions in the next few days, so you can all follow up with those startups. Manish, thank you very much. Great presentation, and thank you. Okay, and with that, thank you very much for being, it was the formal evening is now coming to an end, and now is the informal networking, getting to know each other more with much more drinks outside. So please join me outside.